Now, with all the experience that both of you have, I wanted to pick your brains about what we're currently seeing in the property insurance market, specifically regarding wildfire exposures. According to the California Department of Insurance, the insured wildfire losses from just November of 2018 was more than $12 billion. That's just November in 1 year, 1 month. And 2018 wasn't just a one-off. According to the National Interagency Fire Center, in 2015, there were more than 10 million acres burned in the U.S. 2016, that dropped down to about 6 million, but then 2017 was back up to 10 million, and 2018 saw about 9 million acres burned. Tim, are you seeing a lot of your clients being non-renewed?
Yeah, we're seeing a fair number of them, and it's an interesting thing. We used to be concerned about whether or not they had 300 feet of brush cleared back from their risk. Now, because we're recognizing that wildfires are a product of the Santa Ana wind conditions that we have in California, those embers can go a half mile or farther.
Right, a mile, I think, was what we saw in the Oak Park in the Woolsey fire last year.
So all of a sudden, the projections, the computer modeling software that carriers use, are now showing risks to be in a brush area that we never considered to have that kind of exposure. In a typical insurance setting, if buildings are 60 feet apart, we consider them to be separate fire divisions, meaning there's not really a potential of the risk spreading from one account to the other, one building to the other. Now that's just completely a different circumstance altogether, and accounts that we never ever dreamed would have a brush exposure are either being non-renewed for wildfire or the rates are increasing dramatically.
Kim, are you seeing an influx of applications?
We are seeing a lot come in with the wildfire exposures. And as Tim said, it's a broader brush than it used to be. No pun intended. But it's dipping into places where you wouldn't think they were a brush exposure. So we're seeing a lot more of that coming into the E&S marketplace. And what's having to happen is we have to get more carriers involved. When it's been with a standard preferred market, it usually has somebody that's doing all your property and your liability in a package, and maybe even your D&O. But now with these things coming out with the wildfire, we're finding that we're having to get 3 to 4 to 5 carriers involved in order to be able to write it, because they feel the exposure is so great that nobody wants to put up 20 million or 30 million. They want to put up maybe 5 million or 10 million. So it becomes a much more expensive process just because you've got more people looking at it and the exposure is there.
So in essence, it's becoming a certainty that we are going to have wildfires every year.
Yes.
The question is just,
where's it going to happen? Yeah.
What are the odds that this one's going to go?
Right.
It's a perfect storm in Southern California, Ryan. You've got a circumstance where you've got Manzanita and Chaparral, 2 brush plants that have a high oil content. You've got Santa Ana wind conditions, and you've got an environment where we're building homes farther and farther and farther into these brush areas. So now we've really got ourselves set up, whether you call it global warming or climate change, we've got a circumstance set up where there is really a huge exposure for loss, and the carriers now are recognizing it. And the more accounts they place, the less capital they have to place additional accounts. And I think we're just going to see that scale of premiums continue to rise.
Now, what about those folks that say, well, everything burned last year, there's nothing left?
There's a lot of property exposed to loss, and there's still plenty available to burn.
And I like to point out that all that rain we had, it's lovely, and it's just building new brush for us to burn next year.
It is. If we could talk, there's really 2 different types of accounts in terms of our common interest development industry that are being exposed. There is the condominium association that Kim made reference to, where you have both the units and the common areas exposed. And then we have planned developments where the association doesn't have an insurable interest in the dwellings, but maybe has a lot of green belts and common area amenities that are exposed to loss. And if those fires communicate from those green belts onto the homes, then I think there's a huge liability exposure for the association. So we're seeing, even in those planned developments, where we used to think it was not a big deal exposure-wise, now really being concerned about wildfires.
Yeah, and you're talking about with a planned development, sometimes the premiums were down around $3,000 to $5,000, and now they're looking at $50,000 to $60,000 just for the property coverage.
Right, just for the property coverage.
Because the risk is there. Even if you've got $100,000 in trees and shrubs, that's probably going to go up. And then the cost of irrigation systems, you don't think that the irrigation can melt, but that's going to go.
Yeah,
right?
The heat just absolutely melts them to pieces.